Good morning, everybody. Welcome to our fifth and final webinar at the Wheeler Institute at London Business School on the subject of disclosure, data, and infrastructure related to climate risk. I'm Lucrezia Reichlin. I'm a professor of economics here at LBS. Today, the main speaker is Richard Cantor, Moody's Chief Creditor Officer. Richard, thanks a lot for being with us today. Before I introduce Richard, let me also say that we will have with us another speaker, Shivangi Kumra, who will help me moderating the Q&A sessions. Shivangi is an MBA 2023 here at the London Business School. She has been awarded the LBS Scholarship, which recognizes individuals who demonstrate the school's values. She's very active within the student community on matters of social impact, and she's on the student-led energy and environmental club ESCO, where she's driving their climate change initiative. Prior to LBS, she was working with Deloitte in London in the corporate finance area focused on energy. Before I start, let me say a few words about the Wheeler. The Wheeler is a research institute at London Business School, which was established with the generous support of Tony and Maureen Wheeler, founders of Lonely Planet. The mission of the Wheeler is to apply business expertise to social and economic challenges in emerging frontier and low-income countries. And besides supporting and driving research at LBS, the Wheeler also deliver public talks and events, and today is one of such events. Now, few words about housekeeping. The webinar will last 1 hour in total. We will start with a conversation between Richard and I, and which will be followed by 20 minutes of question and answers. The question and answer function is enabled already, so from the very beginning, so feel free to submit your questions, and then we will do our best to collect them and so that everybody can have a voice and express his opinions or ask questions. So I will moderate the first part, and then I will give the floor to Shivangi to moderate the Q&As, as I said. Okay, so Richard, back to you. Again, it's a pleasure to have you here. Richard, you have been Moody's Chief Credit Officer since 2008, and you are responsible for the rating agency's credit strategy, thematic research, models, and methodologies. And during this period for 10 years, you have served also as Moody's Chief Risk Officer. And most interesting for us today, you have also been a member of the Task Force for Climate-Related Financial Disclosure, the TCFD, member of a work stream supporting Glasgow Financial Alliance for Net Zero, and co-chair of the Pacific Economic Cooperation Council. So you have been very active in the field of climate-related financial risk and so on. But prior to do this work at Moody, you were an economist like me, so that and you worked at the Federal Reserve of New York, and you taught also at several universities. So let me start by asking you on how did you get to this field, and how did you get to, I imagine, to the convictions that the private sector can actually have a role in helping transiting to net zero, and in particular, what was your experience when at the TCFD, the Task Force on Climate-Related Disclosure, etc., that has been a very pioneer in this field, and definitely helped raise the understanding on risk related to climate for private companies. So can you tell us a little bit about that?
I will try to answer your question. And I first want to thank you, Lucrezia, and the Wheeler Institute for having me to participate in today's program. Thank you very much. And it's a great question for me to think about. As you mentioned, I'm an economist by training. I've always been interested in public policy, but I always kind of envisioned a bit of a split between economists and public policy recommendations and the implementation of public policy. And the private sector's role was really just to go maximize corporate profit and work within the construct of what public policy had set as the rules of the road. And when it comes to climate issues, clearly there's a market failure. There's an externality. Economists generally recommend a carbon tax. And the way I'd always thought about it was, okay, well, let's leave that to the public sector, have a carbon tax, and I don't have to worry about this anymore. And it turns out there's not just a market failure at present, there's also a public sector failure of sorts. It's very difficult to get any, the kinds of policies we need. And so we need an all of society approach. And that was something that I had to come to learn really and think about. I was inspired by the speech Mark Carney gave as a wake-up call that many people in the financial services sector, the tragedy of the Horizon speech. And that actually led to Michael Bloomberg, Mary Shapiro, and Mark Carney kind of helping to establish this TCFD. And I participated in the TCFD. I was very eager to learn more about it, to help my company perhaps engage in that area, but also to really learn more about what other people think about these issues. And on the commission, most of the people there were chief sustainability officers of different types of organizations, people who were really much, living this, working on this for a decade or more. And I learned so much from them and have been very eager to continue participating and helping in any way I can, helping my company support a move to net zero, but also the broader economy. So it's been a good journey for me. I also have children who are the age of many of your MBA students, and they're driving me and their friends in our conversations in ways that I never thought I would go. And I really value those conversations, what I'm learning from the younger generation.
Okay, so yeah, that's very clear. And, I think, when we started at the IFRS and the project of establishment a sustainability disclosure board for standards board, we got very much inspired, of course, by the work of the TCFD, and actually what we are now recommending is very much based on that work. And so hopefully we are making some progress. And we had other speakers in this series talking about that. But actually, it would be interesting, given your role at Moody's, talking a little bit more in details about what is the role that credit agency can have in this space, compared with the role of, played by other service providers in the global capital markets. Right.
So the company I work for, Moody's Corporation, we describe ourselves as an integrated risk assessment company. So we do a lot of different things in the risk space. But the main operating subsidiary that generates, its best known part of the company is the credit rating agency called Moody's Investor Service. And that's where I've had the great opportunity to be chief credit officer for some time. And I want to first talk about the credit rating agency, and that's what you asked about. The focus at the credit rating agency is a really important one, but it's somewhat narrow. It is producing ratings and research that supports those ratings that reflect upon the risk of default and loss on debt securities, loans and bonds. It's pretty narrow, but again, it's important. There's hundreds of trillions of dollars of debt in this world, and there are many sources of information about how to think about that debt. But I think rating agencies' ratings is an important part of that. And when it comes to issues related to climate, carbon transition and physical risks, these are important to the ratings of companies and governments, and even potentially structured finance securities. So climate issues are credit issues. We're interested at the rating agency on how, say for a firm, climate risk and opportunities could potentially impact enterprise value. So it's kind of that financial materiality concept that I think you discussed when you discussed the ISSB disclosures. So it's financial materiality. We take the perspective, again, of credit analysts, a little different from equity analysts. Similar, both are interested in enterprise value, but again, we're focused on the risk of loss on debt securities. And so we're not worried about corporate profit fluctuations as much. Of course, they can impact the ability to repay debt, but there is a little bit different orientation between credit analysts and equity analysts. And just to go back to the concept of financial materiality, just to repeat what most of your viewers know, that there's a concept of financial materiality and there's a concept of double materiality. Double materiality also includes a consideration of how companies' behaviors, in the case of climate, perhaps their carbon emissions, affect people and planet or affect the climate. And at the rating agency for credit ratings, we don't have a direct interest in that for our credit ratings. It could blow back in terms of reputation or cost of funding, so it's not irrelevant, but it's of secondary concern. The main concern is what is the direct costs of carbon transition or physical climate risks on the firm and the potential for credit losses as a result. We do have ESG ratings or sustainability ratings that have a double materiality focus elsewhere in Moody's Corporation. We can talk about that later perhaps. But again, we have that financial materiality focus on credit at the rating agency.
You know, in our consultation at the FRS, we have been actually criticized because of our focus on financial materiality. And many claim that actually it's very hard to distinguish between single materiality, or financial materiality, and double materiality, also the effect that companies have on the environment. And this is because of externalities, but also because the preference of investors are also shifting, and the investors are more and more interested about the effect that companies have on the environment and not only on enterprise value. So, what is Moody's perspective on that? I mean, that you draw a very clear distinction, but.
Right. Well, you're entirely right. The distinction is not as clear-cut as implied by what I said. And certainly an important component of credit analysis is the ability to access funding and the cost of that funding. So if the impact of a company on the environment or people and planet is such that it, as I mentioned, kind of blew back in terms of raising their cost of funds because investors didn't want to provide them capital, then that would be quite material. And that may emerge, and we'll certainly be monitoring that. There is one thing to keep aware, and we have a third of all assets in the world are currently reportedly tied to ESG related funding. So it seems like we're really moving in that direction. Having said that, the cost of funding is determined by the marginal investors' willingness to lend, not the average. So it is a reality that you can have a high percentage of the market refuse to fund a particular company, and it might not significantly impact its cost of funds. So it's something we're watching, and it's something we're happy to consider if it becomes credit relevant, but we need to watch and wait.
Yeah, I think from a finance perspective, it's very interesting because, we think that preferences are fixed, but in fact, in this world, actually, they are shifting, which makes this all, conceptually very difficult, to work in this environment. But I mean, and imagine you do the same. Distinguish between physical and transition risk. And now, for transition risk, the rating. How do they affect energy companies or mining sectors? I mean, these sectors which are more exposed to transition risk. So, how do you deal with this problem?
Yeah, great question. We've been on a journey at Moody's trying to increase the transparency around how we incorporate issues like carbon transition risk into our ratings. We published a methodology that kind of lays out not just that, but all ESG risks, how that affects credit. We profile each issuer in terms of their exposure to like 15 different ESG risks in our taxonomy, including carbon transition risk. And for the firms in the highest emitting sectors, say for a dozen sectors in energy, transportation, and building construction materials, those in mining, those kind of sectors, we do really detailed carbon transition assessments on a 10-point scale for each firm in those industries, compare one to another. We have conversations with almost all those firms about their transition plans and strategy. So we do feel we have a good understanding, to the extent the firms know what they're doing, about what firms are really trying to accomplish. In terms of its impact on ratings, we have had training that we give to all our analysts. We've taken the view that while we do have a specialized group that focuses on climate issues, that it was really important for us to develop a base of knowledge on climate risk and opportunities throughout our organization. We have over 1,500 credit analysts, and we've trained them in that area. So we do feel we have a good understanding of the strategy. A lot of the issues are still somewhat uncertain and in the future, and so we don't know precisely, I don't think anyone does, what the impacts will be, but we do know that these are, for the high emitting industries, certainly creating high risk for most of the players and some opportunities. And what we've done in recent years is when we conclude on ratings and our rating determinations, we ask the people involved in those ratings determinations to identify what the credit impact has been of ESG factors, and in many cases it's carbon transition, on the rating outcomes. So whether the impact was positive on the ratings, so lifted the rating level above what it would otherwise be, or whether it's lower, and if so, whether it's by more than one level. So in the sectors that we were talking about, the high emitting sectors, there are, most companies are affected negatively, and a good proportion of them are affected by one or more rating levels lower than they would otherwise be. There are a couple of firms, say a very green utility focused on renewables, who might actually have a rating level higher than it would otherwise be, or an auto manufacturer that's heavily committed and prepared to go into electronic vehicles and the like. So it's a mix.
So if I understand well, so you are using data on emissions, but also data on strategy and more qualitative data on how companies adapt to this risk.
Maybe I can be a little more specific first, before you finish your question, if you don't mind. So for those high emitting sectors, we have two prongs, I think, of analysis. One is an objective strictly data-oriented approach of these carbon transition assessments, which really have three broad elements to them. For each industry, we've decided on a couple of key metrics that we think well describe your current position. could be a carbon footprint, intensity of something like that. Then we have a medium-term view. We know what regulations might be affecting your industry in the near term, sort of a 3 to 5 year horizon. Look at what have you announced as a strategy, or how well are you positioned to deal with what's coming in 3 to 5 years. And we discuss what metrics we've chosen and why. And we limit ourselves to things that are public and available for basically all firms. And then we have another metric that looks further down the path, 10 or more years. It might be, what the firm's established electronic vehicle policy projections are, or basically kind of projections of some sort or another. It depends on the industry, which one. And we take these and we come up with an actual score, and that's just an objective score. And then we take that to the analysts, who discusses that score and other issues and strategy and the like. But that first score is public, and then the second score, which is an adjusted score, reflecting the analyst's views and comparisons to other companies along those same dimensions as well.
Now, we have talked about different industry, okay? So the heavy emitters, and the issue of transition risk. But what about countries? Because another issue that we face, okay, in the work of the SSB, that led to the SSB is, and especially in our interaction with the G20, is that a lot of emerging markets said, wait a second, okay, so that you have to apply different criteria on disclosure for emerging markets because companies, are less mature on the awareness of all these issues, and also because emerging markets, are for some reason growing faster and latecomer in this, in this commitment to climate transition. So, do you have factors for emerging market companies, or not? Okay, so that.
No, we really handle them the same. I mean, most of the emerging market companies that we rate are trying to access global capital markets. They issue in some of the major financial centers and actually have the same level of disclosure typically as advanced economy corporates. So in the corporate sector, it's really pretty much the same. We do have subsidiaries that operate in local emerging markets, particularly right now in Latin America. We have what we can call local rating agencies, and they have a whole different approach to credit ratings. And I know they're in the progress of developing kind of ESG type ratings and green bond assessments for those local markets, because they're also governed by different taxonomies and the like. So there is some specialized work for emerging markets, but in terms of, I think, the big picture for credit rating agency, Moody's Investor Service, we treat them the same.
Okay, now let me just switch the focus a little bit, and I would like you to describe the kind of work that you're doing for sovereign risk, which is I think it's a topic that maybe hasn't received as much attention, but probably that will become really important. So can you tell us what Moody is doing in that area?
Well, it is of course, it's the world's largest debt markets, when we start thinking about portfolio alignment and net zero issues, how we treat sovereign debt is going to be, I'm sure, controversial, just as it's been in terms of Basel capital rules. I mean, it's a sensitive area. I'm not getting into that per se in my discussion right now, because I'll just share with you that we rate corporates, we also assign credit ratings to sovereign governments. And in evaluating the risk to a sovereign government, there's sovereign government debt, you have all the normal fiscal considerations, and you do also need to consider the physical risks associated with climate change and transition risks associated with shifts away from fossil fuel and how that might impact the creditworthiness of sovereigns in the future. And we've done that work. It actually was one of the first sectors that we did this sort of detailed ESG profiling that I described and credit impact scoring that I mentioned for corporates as well. So we've been doing that now for a while. And I would say that we have quite a few, maybe even 40 of the 140 or so sovereigns we rate that are negatively impacted by climate risk. Many of them a notch or more lower in their rating level than they would be if they weren't exposed. Now, these economies, are often island nations. Many of them are island nations or subject to drought and extreme heat risk. So sub-Saharan Africa and India potentially at some point. So the physical risks, particularly the rising tides, the heat, the water shortages, these are sort of foremost in our mind in many cases for sovereigns. We also do have the carbon transition risk for some sovereigns as well. There are quite a few sovereigns that are heavily dependent on tax revenue generated from oil production and oil exports. And for some of those economies, the risks they face are very present from transition risk, or very, very manifest, I should say, and their ratings are lower as a consequence. For others, with effectively the deep pockets provided by sovereign wealth funds, they may be able to fund a transition away from fossil fuels without serious credit deterioration.
So do you think that in your interaction with the sovereigns, do you think that there is sufficient awareness about these implicit liabilities that governments have related to this kind of risk?
I think it's very much top of mind in the public sector. Certainly, the nations that are subject to physical risks associated with climate change are mention it with us, but they're certainly advocating in public forums like the UN and reaching out to the G20 for financial support to support risk mitigation efforts, and in terms of also carbon transition. I mean, you see it, it's been prominent for 10 years, and take a country like Saudi Arabia, it's very, very comfortable talking about it to transition the economy away from oil for this reason.
So you seem to be relatively optimistic that countries will, gradually adjust, and because we haven't seen much adjustment. For example, I mean, even in Europe, which is supposed to be committed to the Green Deal, which is the most ambitious transition, public policy program, and we have seen that. These budgets are not particularly green, and that there are lots of delays, and especially now, also with the war, countries have been very fast in going back to certain commitments.
Well, I would distinguish between awareness and action. I think they're very aware, and in the case of opportunities to advocate for fiscal transfers, why not? But no, I would wholeheartedly agree that the action has not been anywhere near what's been talked about, and certainly nowhere near what's needed. One of the challenges we face at the credit rating agency is transition risk can run both ways. We speak so much about reaching a desired outcome like net zero, but the reality may turn out, unfortunately, to be much more closer to the hothouse scenarios where we don't achieve, we don't decarbonize our system. And from a credit point of view, it's quite possible to get too far out in front in your strategy of a shift to low carbon. And so the risk can run both ways. It's really the uncertainty around carbon transition that's concerning from a creditor's point of view. And we've seen the markets, they don't price in that much transition in many sectors. One could argue it's a little hard to read, or they're not pricing in a near-term transition. People were very eager to report that that the green economy was outperforming in equity markets for a couple of years, and the green bubble and all that. You're not hearing about that now because petroleum prices are high and green economy is underperforming. The reality is that the market, what was probably driving some of that shift away from oil and gas was simply oversupply of oil and gas. Wasn't as much a transition. So, and I don't mean to make a judgment and conclusion from all this. I'm just saying it's complex.
Okay, so back to Moody, more specifically, I think it would be interesting to hear from you about, the kind of analytical services that you supply, and that also the data that Moody produces. And I think it would be also interesting to understand this data infrastructure issue, since there are so many data providers. And, frankly, I'm trying to understand this space and to understand, what's the value added of the different organizations and these different data sets. How should we compare them? And, can you talk both? Okay, let's start with the services and then we'll go to the data. Okay,
Well, first, in terms of certain services, I mentioned we do credit ratings, but we also do ESG ratings, and we do green bond assessments and social bond assessments and sustainability-linked bond assessments. And we're hoping to also provide net zero alignment assessments. Thousands of firms have stated a net zero objective, but as they start to lay out the ways in which they plan to achieve those objectives, I think investors will be very interested in knowing who has plans that appear more credible than others. And so we hope to also provide investor value in coming up with net zero alignment scores. So we have a variety of opinions. I would call these are all opinions, but you were talking about data and analytical tools, which is another space. Yeah. And I think Moody's, we've got a lot going on, and so do many other firms. And it's also interesting to think of where the driver for this activity, accelerated activity, is coming from. It is in part just from a general investor interest, as you say, but what I think was really focused the mind was the activities of bank supervisors and insurance supervisors around the world who said to the institutions they regulate, you should be conducting scenario analysis. And so those institutions say, wait, how do I do this? I need data, I need tools, I need a software platform. So I think you do see the market respond to the need. So that's why you see so many people rushing in addition to other providers who have been there from the beginning. And I don't want to, we owe a lot to them. We stand on their shoulders, people who work for nonprofits, kind of laying the groundwork for kind of ESG work. But so in terms of data, we've put together, I think, some special proprietary tools that we're proud of and excited about. We acquire, mostly through acquiring companies. We acquired a company called 427 a number of years ago, specialized in analyzing physical risk, current and future projections of temperature, of flooding, of tides, of wildfires and hurricanes and all that. at very narrow geographical regions in the United States, say at the zip code or county level. The data set's very, very rich for the United States and growing in other parts of the world. We have, similarly, we have a commercial property database. For the United States, we acquired a company called Reis that has every commercial property in the United States identified and has kind of a profile, and we link that profile with its physical risks as well. So 18 million entities, and again, it's growing, that database is growing globally. And then we acquired a company, it's called Bureau van Dijk, a European company you may know, had a product called Orbis. We've now brought that into Moody's and expanded it, but it has an incredible number, 400 million corporate identities, entities and profiles, with different levels of detail for each one, but some profiles that we can link up with some of the information I've already shared. So a lot of kind of unique data, but then in terms of the analytical tools, I mean, there's just a suite of tools that serve different purposes, and many of them we're trying to link together. So one tool is simply how do you help banks do their loan underwriting? So this is something we've been involved with for 20 years, providing software to banks to kind of just keep track of their loans. What do they want to consider? Kind of it's a data, to help them database what they're doing, and we add a climate module to it so that they can consider climate risk issues in a consistent way. We have acquired the world's leading firm in modeling catastrophe risk, RMS it's called. So they're specializing in figuring out the risk of these particular disaster perils, these various perils, and how they might impact corporates, sovereigns, or municipalities, or the like. We have a supply chain management tool that we've rolled out recently, which links all these identities. Most of there's a lot of interest in supply chain management right now. Of course, know your customer is huge for obvious reasons, but there are many reasons to care about it. And this tool we think is going to be helpful for people in managing Scope 3 emissions. We've got important, and this is, we have climate adjusted PDs for many of the assets that banks hold. This is again important for meeting the supervisory needs, bank supervisory needs. So for corporates who are not necessarily, large scale corporates that have Moody's ratings and very, very detailed analysis of their individual disclosures, but for smaller companies, how can you take a view on their climate adjusted PDs under those different scenarios that the Network for Greening the Financial System has laid out as meriting scenario analysis. So we do it for corporates, SMEs, we do it for mortgages, we do it for consumer lending as well, climate adjusted PDs. We have our own portfolio alignment model. There's now many of them, or probably a half dozen at least, that are out there, and they all have different advantages and disadvantages depending on the assumptions you use to get to the final results. And we're quite proud of ours. And then the last topic I mentioned is macroeconomic forecasts that's conditioned on different climate scenarios. So we know that there's a possibility of having hothouse scenarios or effective transition to net zero, either rapidly or more gradually. And so these critical scenarios, what do they imply for different macroeconomic outcomes across countries? So we have a model of 70 countries where we can make predictions about how different levels of heat and drought and whatnot will affect the agricultural production, will affect tourism, will affect the productivity of workers, will project the demand for oil and energy to support air conditioning or heat, depending on whether it's gotten, you need more, what you need more of in different scenarios. So there's quite a portfolio, and back to your original statement, Lucrezia, I don't know exactly, how we can coalesce around a shared common approach, because right now we're still in the development phase across many firms.
Yeah, we just came at the end of our time slot, but I think that if you look at the future, obviously there is a huge space for companies like yours to do analytical tools. But on data, don't you think that these data should be shared? For public policy purpose, for research purpose, there should be a common good, right? So that because we need comparability, we need to understand this risk, and then while now it seems like it's a lot of competition, it's a little bit of a jungle of data providers, and I think maybe the next step would be to have some common repository where these data could be shared, and then then Moody's and Standard & Poor's and so on would do the analytical stuff and the analytical work.
Well, the ISSB's data, when companies start reporting on a consistent basis, that will be, private companies will help gather it, but they won't have real ownership of it. So that'll become public. That'll become public and shared. And any of these data sources, can be made public. The fees are not generally that high for accessing some of this data. So there may be a cost or return on capital for the people who collect them. But I don't think that is the biggest concern. I think what you would like to see, and what we've sometimes had success with, is when banks supply all the data that they're going to ultimately need to gather on their customers, and they put them in a consortium and anonymize it and make that public. That's really the case where we can all win from that. And I hope to see something like that initially.
Yeah, hopefully we'll get there. Okay, so sorry, we are gone a little bit of time, so I think that now it's time for question and answer. Shivangi, the floor is yours, and to manage the questions. Thank you, Richard.
Thank you. And thank you again, Richard, for joining us today. So we've got a few questions. We'll try and see how many we can get in. So I think maybe starting with the first one, you touched a little bit about on emerging markets earlier. So there's a question here from Jose. He's asking, does the current inclusion of sustainability criteria into the credit rating of a country now going to push up or lower ratings of lower industrialized countries? And then linked to that, he wants to know if this is going to be kind of a significant movement, or there's going to be other frameworks around this.
Okay. Well, I probably wasn't sufficiently subtle in the way I explained the way that climate issues and sustainability issues work their way into ratings. For us, this really isn't anything particularly new, in the sense that anything that's likely to impact future, in the case of sovereigns, fiscal balances or macroeconomic growth, is going to impact the creditworthiness in the rating. So it's not that we're newly introducing sustainability issues into ratings. It may be that sustainability issues are becoming more relevant. So we don't think of ourselves as really having changed. So, but will climate become more relevant for sovereign nations? And some of the poorer nations in the global south are most vulnerable to the impact of physical impact of climate change. And unfortunately, yes, without strong mitigation, financial support to finance that mitigation, it may very well be that their revenues and their tax will go down, their tax needs will go, their spending needs will go up, and their creditworthiness may decline.
Okay, thank you. And then we've got another question that's going to be slightly tangential, but it is very relevant to, I guess, what's happening right now. So they're talking about kind of the sanctions in Russia. So they've said, if you could comment a little bit on the sanctions placed on a debtor that's maybe willing to pay its debt and prevented from doing so. So that's effectively speaking about Russia right now. And then how does that affect its ratings and what's the legality of it?
So Moody's and I think all the major rating agencies have withdrawn all their ratings on Russian entities at I think the EU's requirement. So we don't currently have ratings outstanding. With respect to the Russian government's debt service payments or not, just the way I look at that, I would say is there is a question that we regularly ask about whether bondholders have been received payment for their securities. And when we assign ratings, we often talk about them as the rating of an issuer, a debt issuer, a rating of a company, a rating of this. But at the end of the day, we're not really rating a country or a company. We're rating a bond from the perspective of the investor. So we would say, so we say shorthand, we might refer to a company's rating, but we really would say, what's the risk of a bondholder faces of not receiving a timely payment and full payment on that bond? And so whether or not, that's the question that I would say. Not, I don't really have a view or don't need to have a view. I don't need to have a view on whether Russia defaulted or not. I think there are investors who, if they don't by May 4th receive additional payment, they will not have received money on their bonds, so they will have experienced a default.
That's really useful. And I think you've answered another question in the chat as well, which was kind of related as well in terms of how this changes across, I guess, different countries, particularly oil-producing countries. So another question is related to what you were just speaking about earlier. So we talked a lot about climate risk opportunities, like the frameworks and how useful it would be have to kind of one collective framework too. As one attendee from the audience has asked about the climate risk and opportunity matrix that you are using and maybe what that looks like.
So I'm not aware of a climate risk and opportunities matrix per se, and it's an intriguing concept. So if anyone has some information there, richard.cantor@moodys.com, I'd like to see it. But maybe the terms being used more generically, how do we assess, what are we thinking of opportunities and risks? So it's very industry specific, although there are commonalities, of course, across industries. So in each industry, you identify what carbon transition is likely to look like. So there may be a different way of delivering the product or modifying the product or creating the product. So the different technologies, some of the technologies are not going to be known, but so there's going to be, those are the risks of getting too far out in front and lagging too far behind. Those are all considerations. There's the potential to rely on technologies that are not yet discovered. So these are all the risks and opportunities. It's really a conversation that we have with investors and issuers in those markets, and what do they see as the risks and opportunities, and we reflect that back in our analysis.
Okay, so it's not yet kind of one standardized framework that's separate to the work that you do. It's more just kind of evolving conversation and feeds into that discussion.
Yeah.
Okay, that's useful. That's some of our questions from the chat. So if there's any others that the audience would like to add, please send them in. We might have time for a few more. In the meantime, I do have a couple questions myself as well. So if I could just add those into our discussion. So I think one question was, since the predominant audience, I think, are students or incoming students, maybe could you talk a little bit about people who are kind of transitioning into the career, and in terms of what advice you would give to either a sustainability professional who then wants to kind of move into finance or ratings, and equally somebody who's kind of got a more technical skill set in terms of having done like credit ratings before and now wants to kind of develop a sustainability angle to their work. What would you kind of recommend as kind of the segue to that next part in their career?
Well, I'm not sure I'm in the best position to make that recommendation, because I'm a little far removed from the issues you described. I would say, you know, there are definitely multiple venues where you can engage on sustainability issues. Clearly, there's the public sector, and at my graduate school graduation, a man named Paul Volcker said there's no better career than working in public service, and just made that recommendation. And I went, after a few years, went into the Federal Reserve System and really did enjoy my 10 years there. So I think we shouldn't underestimate the importance of having strong public servants with the kind of skills that they're learning at LDS. But in terms of mixing between talking about problems, framing problems, working in institutions that may not have direct action, but try to influence opinion, I think it's really important. As we mentioned at the beginning, changing public policy is really going to be the linchpin of getting something accomplished. I think the financial world, private sector is stepping up a bit. You can always question its motives, but at the end of the day, I think there's a net push that's very impressive from the private sector to move these initiatives forward. But there also is a role for grassroots activity. And as I say, I've been so impressed with the young people focus on action rather than talking. And so if you either work entirely for a grassroots organization to mobilize activity, or you work part-time or in your personal time. But I think that component of a contribution is critical.
Okay, great, thank you. One other question is around, again, ratings, but not necessarily just investment ratings. So one of the emerging kind of topics that we've touched on at business school is how we make consumer choice in terms of our purchases. And we're increasingly seeing lots of large corporates make their net zero commitments. In terms of kind of making that kind of purchasing decision, do you think some sort of rating mechanism would be helpful for consumers to kind of make that decision? What are your thoughts on that, and what's the latest on it?
Well, I think it's a great idea. I guess it's probably not a new idea, but it is interesting that there hasn't been as much growth in that area, given the clear, strong demand for products that, you know, the supply chain is green and meets certain labor standards and the like. So it is interesting that you haven't seen a kind of nationally recognized rating standard emerge. So a great business opportunity and public service opportunity for some people at your school.
Great, and I think we have time for one final short question before we finish. So maybe a final question is, besides climate risks, Are there other variables that you would look at in the broader realm of sustainability? So I think you again touched on it a little bit, but if you can elaborate, and if there are any specific data gaps in terms of assessing climate risk specifically.
Is there any, what's the last part again? Is there any?
Are there any data gaps in assessing the climate risk specifically?
Well, certainly there are great data gaps, and we're hoping the work of the ISSB will help fill them for large corporates, but there will inevitably be gaps for SMEs, small and medium-sized enterprises that, hopefully the bank lenders themselves will request, and also for supply chains, so that the large corporates will request that data and make it public, as Lucrezia was suggesting, at least through some sort of consortium, because it'll be very difficult to cover the entire waterfront of data needs without filling those gaps. And then on the social issues as well, I mean, these are going to become a big focus, I think. Your customer will know your supply chain and understanding where the products are really coming from. Yeah, important. Well, thank you.
Okay, thank you so much, Richard. That was a pleasure. A final call out from me for anybody who's a student here. We are running the Clean Tech Challenge, which is a challenge for those interested in climate or clean tech and have a potential opportunity to solve this challenge. So Richard kind of mentioned a couple of potential entrepreneurial opportunities. If you have an idea and you'd like to work on it, you can submit your submission as part of the Clean Tech Challenge. There'll be more information coming through the Wheeler Group, but we have a deadline of the 30th of April for some pitch decks. So if you'd like to take part, please look out for it and sign up. I'd like to hand back to the Wheeler Institute.
Okay, thank you. Thank you, Richard, Shivangi, and thank you for the audience for the questions. So a recording of the webinar will be available soon via the webpage of the Wheeler. And so, I mean, go and check it up on YouTube, and you can listen to that also and spread it around. I mean, if you think that the content was interesting. Unfortunately, this was the last of our series, but maybe there will be other initiative linked to climate and sustainability, and more content will be available via the usual channels. So thank you, everybody, and thank you again, Richard, and we'll stay in touch. Bye-bye.